Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Another exciting day in markets. Now, I've been speaking for some time, a week now, about how last week was so important, but it would drift into Monday this week, and that's certainly been the case, and it's still drifting. The US stock market unable to kick on to new highs. In fact, the price action on the hourly and 5-minute charts, the intraday charts, looking increasingly heavy. I continue to highlight those levels I gave last week. If we see Thursday's, Friday's lows of New York stock indices broken below, then we could have a substantial bear trend. In my article today, I've written about the US manufacturing slowdown is leading what is a global manufacturing slowdown. It's not so much that the US is creating it, but we've seen it first in the US. And it is a pointer to the continued slowdown in manufacturing in Europe. And also now we have a very clear manufacturing recession in China. We know Germany's in recession. We know Italy's just contracted in the most recent quarter. So these manufacturing giants are feeling the pain of higher energy costs, higher interest rates, higher input prices. The problems stretch across the board. Now, why I keep highlighting this is that manufacturing can often be a lead indicator by 1 or 2 years as to equity market price action. And we've had this slowdown in US manufacturing in place for a full 12 to 13 months now. So it is getting into that risk period for equity markets. And when you have such a big event as last week with the Fed raising rates, going on hold probably for the next 12 to 18 months, the end of rate hikes, and still the stock market was bid into that news but hasn't been able to kick on since that day. And that is the price action that suggests we could be in a situation of buyer exhaustion. And you have to remember that once everyone who wants to buy a market has, it can only go down even if there were to be further good news. But in this case, we're seeing further negative news. Just think about this. The world's 3 major economic powerhouses, the United States, China, and the European Union, are all seeing serious manufacturing slowdowns. And in the US and China, we have clear-cut manufacturing recessions at force. Retail sales in the US were buoyed initially by inflation itself, and now are looking rather lackluster. We've just seen Australia's retail sales drop 0.8% in the most recent month, and we've seen a slowdown in private credit growth. Basically, it's just been too much for the Western economies, but also China. But for the Western economies in particular, it's been too much of a post-COVID dysfunction, disjointing everything, then everything coming back with a big, powerful boom, but all economic activity brought forward out of this current period by all those government stimulus measures and near zero interest rates at the same time. Now we're left with the economic hangover from that, but in what would have already have been a normal economic hangover period, we've had high inflation and very high interest rate hikes from the ECB, the Fed, and the RBA. These economies cannot bear the weight of all these factors. A global manufacturing slowdown, exports out of China falling sharply, suggesting demand from the entire world is weakening, and these higher interest rates, higher prices. So consumers and businesses in this situation are actually kind of a lagging experience to what is happening in manufacturing. They're giving up the purchase of some of the bigger ticket items. Businesses are ordering less equipment. We also have all of these problems in the United States, compounded by the fact of that new FDIC Treasury Janet Yellen program of guaranteeing the deposits of only the 2 big to fail banks 100%, which is not only seeing a movement of deposits out of regional US banks and into the too big to fail, it's leaving a huge, massive hole in terms of funding that is available for small and medium-sized businesses, loans, across Middle America. That's not a space that the too big to fail have traditionally filled. And as the small and regional banks feel more and more pain, it is increasingly difficult for them to lend money to businesses as they try to hold on to deposits and wind back their lending as depositors flee. So the US economic slowdown is going to intensify from all of this, and the outlook for equity markets, I have to say, should be one of great caution. We're seeing that price action is, I know I've said a couple of these things a few times now, but it's becoming extremely worrying, and it is worth paying a lot of attention to even today, let alone across the weeks and months ahead. I hope you have a good day. I'm sorry to be giving you a warning, but it is better to be warned and considered your strategy, because such situations are, of course, full of opportunity. So do think ahead to how you might respond should equity markets begin a bear trend from these levels that no one has really been previously expecting. We've been calling it for a while, stubbornly, but there are certainly price action signs backed up by the economic data that point in a downward direction for the moment, and that can hold tremendous opportunities as long as you've thought about it in advance, developed your strategy so you don't have to be pressured into thinking real time, that you've thought about it in advance, and then you can apply your strategy to make the most of the opportunities that are already present and will continue to emerge. Thanks very much. Have a good day. Clifford Bennett, Chief Economist, ACY Securities.